Is the Fed asleep at the wheel? What am I referring to? So I'm asking the question, is the US sleeping into a banking crisis? Is the Fed therefore asleep at the wheel? So the ECB and the Fed keep referring to sound and resilient conditions in banking, as they obviously need to. However, beneath the surface in the US, there's a mixture of mediocre regulation and bizarre incentives. So therefore, I think it's a fair question to ask, are the authorities being a little bit complacent, or is there stuff going on behind the scenes with respect to a continuation of the banking crisis that we've seen already? So far in 2023, Silicon Valley Bank, Signature Bank and First Republic Bank have all failed. Is this the tip of an iceberg? The April 2023 Senior Loan Officer Opinion Survey on Bank Lending Practices, or the SLOOS, was released on May the 8th, and I shall be referring to this later on. Bit of background: since 1870, we've had 14 big world recessions. These have been driven either by wars, pandemics, or banking crises. If caused by a banking crisis, the average drop in global GDP per capita has been in the region of 4%. Here's a chart going back to 1873 showing you global recessions and the declines associated in terms of real GDP per capita and the causes. As you can see, we've had numerous banking panics, and of course the most recent and most famous one was the GFC in 2008, which caused a decline in real GDP per capita globally of 2.9%. Now, what we can say with certainty is that banking crises will always be followed by tighter lending standards, which kind of makes sense. Tightening lending standards will affect disproportionately small businesses in the US. I've got a chart here which shows you the bank's usage of the Fed discount window versus tightening lending standards for small businesses. As you can see, the dark blue line is when that spikes, that's when the banks are taking advantage of liquidity, essentially, from the Fed. And at the same time, or maybe with a small lag, you'll see the lighter blue line where, as a result, the banks will then tighten their lending standards, particularly for small businesses. As you can see, this peaked back in the global financial crisis in 2008. We had another peak in 2020, which was COVID related, and of course, most recently in March. Here's a chart that shows you that tighter credit leads to lower small business optimism. So, not surprisingly, if the banks tighten their credit terms, this is going to lead to a decline in small business optimism. Obviously not good for the economy. And then related to that, further down the line, what you tend to see is that as the availability of loans decreases to small businesses, that will lead to layoffs. And as you can see in this chart, I've overlaid the availability of the availability of loans to small businesses versus initial jobless claims as a measurement of unemployment. As we've already seen in these charts, banking crises are always followed by tighter lending standards and lower risk appetite. Small businesses are the most negatively affected, and these are the guys who are the most reliant on regional bank lending. US small businesses creates about 2/3 of the jobs in America, so lower availability of credit for these businesses causes an increase in unemployment. Now, banks with under $250 billion of assets on their balance sheets make up 80% of commercial real estate lending. We've already seen at the end of Q4 last year very high US office vacancy rates in the region of 19%. And we know that since mid-March, commercial real estate has been widely seen as the next shoe to drop. A US bank with a balance sheet less than $250 billion, which is where the regional banks all sit, do not have any need to adhere to what's known as the Net Stable Funding Ratio, the NSFR. The NSFR forces the large banks to have a good proportion of their liabilities in sticky, long-term funding. This limits their liquidity risk. Small banks don't need to adhere to that, or medium-sized banks. They also don't need to adhere to the liquidity coverage ratio, the LCR, which means that they can buy a disproportionate amount of less liquid securities like corporate bonds or mortgage-backed securities instead of treasuries, which is exactly what they did in the pursuit of yield when we had the previously very low to negative interest rates. And for reference, a balance sheet of $249 billion is not really a small bank. To give you an indication, a top 3 German bank has a balance sheet of less than $200 billion. In the US, unlike in Europe, there's no proper public interest rate risk stress testing. Europe has a fairly extensive framework to stress test the interest rate risk that European banks take on their aggregate balance sheets. So we're talking about their exposure from loans, mortgages, bond investments, bond issuance, long-term liabilities, swaps, etc. European regulators force the banks to publish the results of their supervisory outlier test on interest rate risks. With the SOT, the entire bank's balance sheet is stressed against a 200 basis points or 2% move up in European rates. The net negative impact on capital is reported, and if it's more than 50 to 20% of capital being wiped out, the regulators are called on to intervene. The US does not have an equivalent test. In the last 10 years, the small banks have increased their share of total bank lending in the US. This is why they're so important, because regulation restricted the large banks, forcing those large banks to strengthen their liquidity and capital positions, so the small banks moved in to fill the gap. They became more competitive in the landscape, and particularly so in commercial real estate. As you can see from this chart, the small US banks have increased their market share of bank loans in total from about 15-16% up to a now current 40%, and commensurately the large banks' share of all bank loans has gone down from over 80% down to 60%. So the small banks are now much more important. They've also increased their bank loans as a percentage of GDP, as you can see from the chart on the right hand side, particularly so in commercial real estate. So on to this SLOOS, the Senior Loan Officer Opinion Survey on Bank Lending Practices, which the latest release was on May the 8th. What this looks at is changes in the standards, terms and demand for bank loans to businesses and households over the first quarter of this year, and asks them also about their outlook for the rest of the year. It was pretty much universally negative across all loan categories. So with respect to loans to businesses, the survey respondents reported that on balance, they're seeing tighter lending standards and weaker demand for commercial and industrial loans to large and middle market firms as well as small firms. It's the same story, i.e. tighter lending standards and weaker demand for all commercial real estate loan categories, for all categories of residential real estate, and for all types of consumer loans, autos, etc. The most frequently reported changes in the terms related to wider spreads of loan rates over the bank's cost of funds, so in other words, higher costs if you want to take out a loan, and lower loan to value ratios, in other words, they'll give you less leverage. Why, they were asked, are you tightening lending standards? The response, because of a less favourable or more uncertain economic outlook, reduced risk tolerance, deterioration in collateral values, and concerns about their own funding costs and liquidity positions. As you can see from these charts, we've seen an increase in terms of the tightening of loan standards for commercial and industrial loans. So in other words, availability becoming harder and the terms becoming tighter. The top chart shows you loans to large and middle market firms as well as small firms, as you can see, already started in 2022 and it's carried on into the first quarter of this year. And as you can see on the bottom chart there, that's the level of spreads of the loan rates increasing over the bank's cost of funds, again to larger middle market and small firms, starting the increase last year and continuing this year. Next chart shows you the demand for commercial industrial loans. As you can see, for larger middle market firms and small firms, that started reducing in 2022 and has continued to reduce in 2023. Lastly, here's the outlook in terms of supply and demand for commercial real estate loans. As you can see here, tightening lending standards and lower demand. So in conclusion, the banks were also asked about their expectations for the rest of the year, and what they reported was that they expect to tighten standards across all loan categories for the rest of this year, most frequently on the basis of an expected deterioration in the credit quality of their loan portfolios, in customer collateral values, a reduction in risk tolerance, and concerns about banking costs, bank liquidity, and deposit outflows. And these were the principal reasons that they expect to tighten their lending standards for the rest of the year. Particularly the mid-sized banks, in other words, the epicenter of the regional banking sector, more frequently reported the tightening in standards for business loans than either the largest or the small banks. And this was both for the Q1 that we've just seen and in expectation for the rest of this year. What does this all point to? At the very least, further economic headwinds and possibly a lot more pain centred around the regional banking sector.